So, common trading mistakes to avoid. Again, my name is Greg McLeod, and it's great to be with you again. And we're having a great expo, a great boot camp, and hope you guys are learning a lot. How you guys doing out there? You learning a lot? And as we go through the presentation today, I want you to have some takeaways, about that you could take away from this presentation as far as the one thing or the several things. There's about three major things where traders actually mess up, and one of the major things is being over leveraged and trading too often. But Steve, Jason, Jarnell, good. So let's go ahead and get started here with common trading mistakes to avoid. Again, presentation. I want to thank AuraFX for the opportunity to be able to present this and share this information with you. And hopefully that after we go through this presentation, you'll avoid the common pitfalls that many traders make. In fact, about 90% of all traders who wind up losing and being unsuccessful and dropping out. Because I want to tell you something. There's one thing in common. Professional traders, good traders, bad traders, traders have one thing in common, and that they all do lose money. Let me tell you that. If you ever hear about someone or you get an email or something that says, hey, I got a 100% system with no losses, run away. Delete it. It's spam. Everybody loses, okay? The difference between a professional trader and a winning trader, a trader that's going to continue in this Forex market as a trader, must learn to accept losses, but also learn to keep those losses small. Okay, so I want you to just keep that in the back of your mind that we're kind of like raised in this society where when you're at school, what's the best grade you can get in school? And you just go ahead and type it in the box. What's the best grade you can get in school? An A, right, Jason? An A. And that's usually what, 90 to 100, right? That means that, okay, you're right 90% of the time and you're wrong about 10% of the time. And you realize in trading, it's completely different. It's more like baseball, where if you bat 300, you bat 30%, you're a Hall of Famer, you're a champion. But if you are, but in trading, we're going to turn that mentality, that 90%, that A+ mentality around, and that's going to rub people the wrong way. The ability to learn to lose. But let's go ahead and get with our presentation. Okay. Here we go. Jason says, congrats, Steve, for getting the A+. Nice. Okay. Let me go ahead and give you the risk disclaimer. Make sure you understand all the risks associated with foreign exchange trading as we get started with our presentation here. And again, my name is Greg McLeod, and for those of you who just come into the room, I'm a 20-year market veteran, and I've worked at one of the largest Forex brokers in the world for 8 years. I've hosted a live scalping show called Pip and Run, and I showed people how to scalp the market, the $5.1 trillion a day Forex market, and worked with specific AuraFX live account holders. So it's great to be able to have this opportunity to share with you. But if a trader loses money, what is the primary reason? Okay. The fact is that most traders, regardless of how intelligent and knowledgeable that they may be about markets, lose money. What could be the cause of this? Are the markets really so there you go. I love that word, enigmatic, that few can profit? Or are there a series of common mistakes that befall many traders? The answer is the latter. And the good news is that the problem, while it can be emotionally and psychologically challenging, can be solved by using solid money management techniques. Most traders lose money simply because they do not understand or adhere to good money management practices. And let me preface that all traders lose. The key is to keep your losses small while making your winners larger than your losers. Okay. In fact, if you could win if you had a 1 to 2 risk reward ratio. And we're going to talk about that. I don't want to get ahead of myself there, but Albert Finney in the movie A Good Year is losing is part of life. Is the whole thing is not to do it too often. Okay, so let's go ahead and look at this. So we're looking at consistent and sound money management. Money management. A big part of money management is essentially determining your risk before placing a trade. Without a sense of money management, many traders hold on to losing positions far too long, but take profits on winning positions prematurely. The result is seemingly paradoxical scenario that in reality is all too common. The trader ends up having more winning trades than losing trades, but still loses money. And that's a real, a real issue. It's like, oh yeah, I got 90%. You're right. Okay, I got my A in trading because I've got more winning trades than losing trades. But since I only make small amounts of money on my 90% and big losses on my 10%, then I actually end up losing. So we want to flip that around. In fact, as traders, as professional traders, our first goal is to protect our capital. We want to protect our capital. And then our second goal is to grow that capital, grow that nest egg that we have. Okay, so let's look at how we do that. So key money management practices: risk-reward ratio. So this is a key word that you should know: risk-reward ratio. You're going to see that commonly called, you'll see it as RR. So traders should establish a risk-reward ratio for each trade they place. In other words, they should know how much they are willing to lose and how much they are seeking to gain or to win. Generally, the risk-reward ratio should be 1 to 2, if not more. And this means that you should equal no more than 1/2 of the potential reward. So basically, you're risking $1 to make 2. So if you lose $1. But if you win 2. Now, if you do the math on that, if you took 10 trades and and maybe lost half of them and won half of them, well, if you're winning $2 on your winners and losing only $1 on your losers, then you're going to lose $5 and win 10, so you're going to net out $5. All right. Now, how many times would you crank that certain function if you have that working for you? You would do that a lot because the odds are in your favor. You have an edge. So having a solid risk-reward ratio can prevent traders from entering positions that ultimately are not worth the risk. And that means being choosy about your trades, not going on a gut feeling or a hot tip without having a knowing where you're getting out and how much you're going to get out of it when you win. So the key money management practices. Our tool, our savior, our friend is the stop loss order. Okay, and a lot of people don't like using stop loss orders. They say, you know what, I don't want to take a stop because I don't like losing money. But that's part of trading is losing some while making more. Think of an artist who's a sculptor, and he has some a block of stone, and he says, well, I really don't want to waste any stone, so I'm not going to really chisel anything. You're going to lose some stone as you carve out a statue or something, or if you're carving something out of wood, there are going to be wood shavings. If you make a cake, there's going to be some scraps. There are going to be some byproducts. And so as you're trading, you're going to create losses, and those losses sometimes will tell you what direction you need to be in. But the key is to make them small. And so many traders really go into the market thinking, oh, this is the. I remember trading back in the 90s, and you're trading Yahoo and the internet stocks, and things are moving so rapidly, and you basically like put all your money on one stock and you let it roll, which is what they did back in the back then, kind of those days. Instead of actually looking at trading as one trade, as one in a series of 1,000 trades, that one trade should not be your, this is it, this is my lottery ticket. Instead, it's just one trade that represents a small percentage of your capital, which when you take many trades over time will add up to a rising equity curve if you have a solid money management system, as well as a solid risk reward and a solid entry and exit system. So the stop loss order is a way of controlling your losses and getting you out of positions which are not moving in your favor. So not only should you employ a stop loss, and you should be willing to accept it as part of the cost of doing business. You buy insurance for your car. You may never have to use it, but the moment you have an accident, you have that insurance to protect your car. But you say, well, I just pay $300 a month, and man, I'm not even using it. But I tell you what, when you have an accident, that's $300 well spent. And so a stop loss order is very important, like an insurance policy. So due to the importance of money management to long-term successful trading, the use of the stop loss order is imperative for any trader who wishes to succeed in the currency market. Stop loss order allows traders to specify the maximum loss they're willing to accept on any given trade. If the market reaches the rate the trader specifies in his or her stop loss, then the trade will be closed immediately. As a result, the use of a stop loss order allows you to quantify your risk every time you enter a trade. And I had a friend who was a fireman, and when he went into a burning building, he said, hey, before I go in, I have to know where my entry is, and I got to know where my exit is. Okay? So they look at the plans of the building before they walk in. They don't just run into a burning building to rescue someone. They have to know where their exits are. And when you go into a trade, you have to know your exit for profit. But first of all, you need to go know your uncle point or your exit for loss. And you gotta know when you're gonna tap out. if you're a WWF or the UFC a UFC fan, you gotta know when you're gonna tap out. and that's very important to know that ahead of time, because trying to figure that out once the trade is underway, that's trying to figure out how to land an airplane after you take it up in the air is not a really good thing. So you want to have a plan of entry and exit. So two parts of the successful trading is using a stop loss order, initially placing a stop at a reasonable level, and a trailing stop, meaning moving it forward towards profitability as the trade progresses in your favor. And this allows you to a trailing stop is a way of moving your stop as price starts moving up in your favor. You can lock in gains, and being stopped out of a profit is a lot more fun than being stopped out for a loss. And we'll talk more about that. So placing the stop loss. Here are two recommended ways of placing a trailing stop loss order. A 2-day low. This technique involves placing your stop loss order approximately 10 pips below the 2-day low of the pair. The idea behind this technique is that if price breaks to new lows, the trader does not want to hold the position. For example, if the low on the euro dollar's most recent candle was 1.2900 and the previous candle's low was 1.2800, then the stop should be placed around the 1.2790 or about 10 pips below the 2-day low. If a trader wishes to enter, now as another day passes, the trader can raise the stop to 10 pips below the new 2-day low. So in this way, you're letting the market tell you where the stop should go. So as price starts to move up, you're locking in gains, and you're staying below the range range of that particular currency pair. Now, the parabolic SAR, usually SAR stands for stop and reverse. So this is another type of stop, and so one type of a volatility-based stop that is found in many currency charting applications. It's like a little dot that appears below a candle or above a candle, and so now I'll show you an example here of how that works. I think is there a okay? I don't have a chart example. This below is a chart example, and I don't believe there's one here. But if you go to the parabolic SAR, the dot is automatically calculated based on a formula, and so when the candle bar moves below the dot, it means that that's where you would place your stop, and that's where you'd be stopped out. So it's automatically calculated by the platform. Most platforms have this in their indicator section. It's called Parabolic SAR. So finding your identity as a trader is very important. So many traders struggle in the early days of trading, formulating an approach that fits their schedule and demeanor. So let's explore the styles traditionally explored as traders gain more time in the market. And now trading is not one size fits all. You're going to find there's swing traders and position traders and scalpers and day traders, and based on your time available, if you have kids and a family, maybe being an active trader is not for you. Maybe if you only have small windows of time, maybe being a position trader suits you. Or maybe you might even do like Jack Schwager, who was the author of Market Wizards. He found that he did better as a systems trader or an automatic trader, where he created systems or he found systems, programmed them, and allowed those systems to trade on his behalf. And he found great success doing that. So you're going to find your identity as a trader. We're going to talk about that. So here we go. Different styles of trading. You have day traders. And day traders have a reputation, here in the U.S. in the 90s, being high flyers and just making a lot of trades and actually losing a lot of money. But now we have more. The reputation is more. Had become tarnished back in the 90s, but now it's coming back. So day traders will typically take positions for a few minutes up to a few hours, and day traders usually don't hold positions overnight. They will also usually use very short-term charts, as 15-minute charts, and that's probably where I am in that day trading style. My personality is more of a day trader. Then there's swing traders. May take positions for a few hours to a few days or even a week or two. They may use 1 hour or more charts to do so. And this is probably more conducive to someone who has more time on their hands, or they have more time for their family, but not so much time to sit in front of the computer. They can just take a few hours a day, place their trade, and walk away from the computer, and either their stop is hit or their limit is hit, and they can get several hundred pips by catching the average daily range of a currency pair being a swing trader. And so that may fit more into your lifestyle. Now, position traders typically hold positions for even longer periods of time than swing traders, and this may last a few weeks or a few months. And usually these traders are basically trading off of the fundamentals, whether it's maybe they're trading currency based on the overall economic fundamental picture of a country, and so that trade takes several weeks to unfold, and they've identified some major trends. Now the carry trade, this is one that is made based on the difference in interest rates, in which you're short the lower yielding currency to gain returns on the higher yielding currency, and this may last for a few years or more. And that was really popular at the beginning of the 21st century, beginning of the 2000s, just before the financial crisis, when you had Japan with the ZIRP, or zero interest rate policy, and you had many currencies with very high interest rates. I think we had the UK with maybe 5.25, 5.75 interest rate. You had New Zealand that had interest rates at like 7.5%. So what you could do is you can buy New Zealand yen or pair, which you're selling yen and buying Kiwi, or selling yen and buying Aussie, or selling yen and buying the pound, and holding that particular currency pair long for for many months, then in fact years, and earn carry interest, and that is interest paid at 5 p.m. Eastern time. When you're long the currency pair with a higher interest rate, you earn carry, you earn interest on top of the appreciation in the currency pair, which was a really good deal, and was when interest rates were high, it was a tiny little, not little, but it was a pretty sizable amount of money. Right now, the interest rates are low everywhere, and and we're in search of yield, so the carry trade is maybe not as prevalent, but you can see many other central banks are in cutting mode. We had the Bank of Canada cut interest rates because no one wants a bunch of people piling into their currency and causing their economy to slow down, and interest rates, inflation to go up. Um, so, but those are the four ways. And I would like to add a fifth way, and that's the automatic trading style. If you're using maybe the MT4 platform, there are a lot of what we call EAs, automatic robots that trade, and there's many reputable systems out there which you can back test and use in your account as well. They'll automatically trade for you, and so that's still another way. Or there's even like mirror trading products, which will allow you to to have your account mimic or mirror the trades of other either traders or other systems out there too. So that'll be a fifth way to look. Uh, to, uh, okay, so managing difficult periods in your trading. Okay, and this will happen to everyone. Everyone goes through a slump. Every athlete goes through a slump. Every performer goes through a slump. Countries go through slumps, and it's just part of the cycle. That when you do go through a slump, this is what you need to do. Okay, not to panic, not to stop, not to quit, and not to give up on yourself or be beat up on yourself because you're going through what we call a drawdown. But you want to do this, recognize that you're having some trouble, and take these following action steps. First action step you want to do is decrease your position size. Get small. That's what something we say in the business. If you're having a drawdown, get small, and go demo, pencil to paper is what Marty Schwartz said in Pitbull when he was going through a drawdown. He was a professional trader. He didn't have demos then. He just went to pencil and paper and this went into simulation until he got back into the flow. So decrease position size. Whenever a trader is going through a difficult period, the first reaction should be to decrease the size of the trades. For example, switch from trading 5 lots at a time to trading 2 lots at a time. Unfortunately, many traders try to recoup losses by increasing the size of their trades. This almost never works because it is a decision that is based on emotion rather than reason. The time to size up is when things are going well. That is the best time for traders to get aggressive. And many people, they get involved in like revenge trading, and the market took this away from me. Well, I'm going to go in there, with big size. I'm going to get it back. I'm going to teach the market something, and that happens. The market teaches you something. It teaches you don't revenge trade. So we want to get small and get into the flow, get that rhythm back. Because once you get in tune with the market, then you can start getting your size back up. Okay, so the second thing you do, second action step you can do when you're going through a difficult period in your trading, is to keep a pulse in your emotions. And the best way to remove emotion from trading is to plan as much of the trade as possible in advance prior to entering. Many traders focus on what happens after they enter a trade, but the movements in the price are not under the trader's control. What the trader can control is planning where to enter and place stops and limits, and determine ahead of time what to do in the event a situation may arise. And I was trading a pound dollar. I had a nice wedging formation, got long, and then I got stopped out. Then I switched over to euro pound, and I said, you know what? We have a similar pattern. Looking for if pound is breaking to the upside, euro pound is probably breaking down to the downside. I set a limit. I set a stop, and I went to bed. And I woke up and I had 21 pips. Because I knew that I had my risk already predefined, I had my limit already predefined, and I slept well. I slept well, and when I woke up, it was in the money, and I was able to close that out. So so having the things, the more you have planned, and think about it in your own life, the more, if you're not planned, if your clothes aren't set out, and your coffee maker isn't automatically percolating coffee, and if the car is not warmed up and filled with gas, if you're trying to put gas in your car, find out what you're going to wear, and run around looking for breakfast and trying to do all these things, you're going to be very stressful, and you're going to be prone to more errors and more mistakes. But you find when you have your best day is when your day is planned. And so you want to plan your trades as much as possible, and that way you can be more proactive in your trading and less reactive. I'm going to pause here if there's any questions, but um, the other common mistakes that traders make is over trading. And when I have traders send me their statements, and they'll say, "Hey, Greg, what's my problem here?" Well, it's like you got 100 trades and you did them all in one day, and you're doing good up to this point, and you just kept going. Because the market can be very addictive. It's the adrenaline rush is exciting, and you just don't know when to stop. So you got to know when when to give yourself a break, when to step away from it, and when you can be rested, taking not just a pulse of your emotions, but also taking a pulse of what's going on in your life. If you've had a fight with your spouse, or maybe with your boss, or maybe if you're not in a good mental state of mind, trading is not something you want to do, or to try to express your frustrations or try to do something. So you want to make sure you're in a good state of mind. Whether you're using meditation, or reading some type of poetry or inspirational writings or music, something that's going to calm you down, relax you, and so you can leave whatever troubles you have in your life away from your trading, so you can be of a very clear mind, and you can be present in your trading. And so trading under pressure and trading for money is another thing that you want to avoid. Yeah, money is part of trading, but you really want to trade for the mind, for the setup, to trade well. And if you trade well, and then money will follow when you trade well and follow good setups, rather than, oh, I've got this trade to work because I've got to pay the rent, or or mama needs a new pair of shoes or something. So when you're trading under pressure, you're not giving yourself, especially if you're brand new and you're trying to learn how to trade, having the pressure of money is a very hard thing, to put that undue pressure on your new trading. Your trading is like a little baby, and you're telling the baby, okay, now it's time for you to get a job, right? No, the baby has to grow up and has to be nurtured, and that's how your trading career has to be. It has to be protected and nurtured, and if you give it time to grow and give it time to progress, it can provide for you. Okay, and the C says, do any traders have a mentor to say no or give neutral advice? Yeah, I do so for many traders, and And I know when I worked together with Tom on the desk, he was a great mentor to me, and he's would be a great mentor to you, I'm sure. Um, but you always should find someone who is um, every uh, Tom Brady, a football player, has a football coach. Everyone has a coach or a mentor, and I have a hedge fund manager who I actually talk to as well. So no matter how far you are in this game, you really should reach out and have someone that you can talk to, because your spouse may not want to hear what you have to say about trading. She's going to get tired, or he's going to get tired of hearing your forex stories, and your dog certainly doesn't want to hear your forex stories. So it's really good to get to plug in to a mentor, and when you work with RFX, and you'll be able to plug in and work with us. So that's a very good question, Steve, because you want to get outside. A lot of traders make the mistake of trying to do it themselves, and what happens is they get trapped in their own head, and because you choose trading because you don't want anyone telling you what to do. You don't want to. You're here because you're independent. You don't want to have a boss. You don't want to have someone over you. But in the same time, as a trader, you're like any other professional. You need mentorship. You need education. You need the ability to talk to someone and get guidance and direction from someone who is where you want to be. And anyone who wants performance, enhanced performance, needs to reach out to other traders. And that's also a common mistake to avoid. Not talking to traders and not talking to people. Now you have to be careful when talking about finances and things like that, of course. But you can speak in generalities about, hey, I'm going through this period, and someone say, yeah, I was going through it too. And then you don't feel alone, and then they say, well, I found that if I did this, and they go, really? Okay, fine. I did some acupuncture, and I feel great, and okay, or something, But at least it gets you out of yourself and relieves stress, and that's what you want to do, is minimize the stress, and try as much as possible. Trading is inherently stressful, and so anything you can do to mitigate that will be most advantageous. But keeping yourself healthy as well. If you're trading sick and you're taking medicine, taking, especially a lot of the medicines have narcotics in them. They have either opiates or whatever. You don't want anything that's going to impair your trading. Alcohol, anything like that. Don't drink and trade at the same time. But remember, when you're trading, you have to treat it like a business. You are a professional, and so you want to, just like if you were flying a jet plane, you wouldn't want, or in a plane on a trip, you wouldn't want the pilot to be frazzled taking over the pilot seat. You want him to be in a good mood, a good frame of mind, so he'll be completely focused on getting you to your destination alive. Okay, so similarly, you have to look at that in your trading. You have to take inventory of yourself. Steve, excellent question. Does ego
Hi folks, this is Dan, one of the moderators, just picking up here where Greg left off. If you could just type into the chat room that you can hear me. I know we had a small sound issue there for a minute. Okay, great. So sorry about that. I think there was just a small mute sound issue on Greg's side. I know he took you through the majority of this, so what I'll just wrap it up here, and then we'll hear from Greg again tomorrow. Some of his sessions. So basically hitting the points about managing difficult periods in your trading. This is something we all face as traders. You know, Greg talking about his 20 years experience, and Tom, you know, even longer than that. You know, we all go through this as part of the, you know, it's part of what we accept as traders. You know, as we move towards trading as a full-time profession, like any other full-time profession. You know, trading does have its ups and downs. It has its headaches. It's really it's a matter of, you know, getting to know with firsthand experience how to manage those situations when you encounter them. And as has been raised a couple times over the course of the previous few sessions, is you know, the difference between trading in a live account and a demo account. In a demo account, we tend to forget about the big losers because the reality is the big losers don't impact us financially in a demo account. When you trade in a live account, you quickly become aware that, okay, I can't kind of you know, be as you know, wide open or as you know, I don't want to use the word reckless, but in many cases, when you're placing a position of the size that has the capability of taking out a majority of your accounts at any one time, then we really need to take a closer look at how we're managing our risk. I did want to check to see here. I might have heard if Greg came back on. Greg, are you back on?
Yeah, you know, we get a little bit of rain here. I guess it knocked out the power here.
Okay, I'll turn it back over to you. Still in the same.
Okay. Yeah. So that was yeah. We were talking about ego. I don't know if Dan addressed that, but knowing, you know, being able to admit that you're wrong, and a lot of times they say men have a little bit more difficult time than women as far as asking for help or looking for directions. I know my dad would go on a highway, and this was before the smartphones and things of that sort. And you know, we had maps. It was like, hey, we're driving around in circles, and my mom would say, hey, why don't you pull over to the gas station and ask for directions? And my dad goes, no, I know where I'm going, right? I know where I'm going. Famous last words, right? 3 hours later, we're still driving around the desert in Arizona looking for, you know, the highway. So it's very important to you know, to when the market has us, you know, we're maybe in the wrong side of the trade or it's going against us, that we can say, hey, we're wrong. I'm wrong, and I got it wrong, and it's not. And this is where that years of training of 90% having the A, you know, and you know, where, you know, if you get something wrong, you know, you get enough of the questions wrong, you can't graduate, you can't get a diploma, and you'll, you know, maybe end up in detention. And so we're constantly have this thing in our head that if I'm wrong, I am bad. If I take a stop, if I take a loss, I am bad. And that's some kind of this little message kind of built into people who are not you know, traders, where if you're not an athlete or if you're not into a professional trader, you know that being wrong is actually great, because hey, if I'm wrong and I lose 20 pips and I can get into another position, I can free capital, I can free my mind about this trade next and move on to something else, another trade idea, another setup I'm looking at, and then I make 40, 60, 80 by changing direction, you know, that's okay. You know, I was long Aussie cat today, you know, and I'm like, you know what, this is down 13 pips. I don't think so. I think I'm going to turn around and get short. Bank of Canada announcement comes out, and they keep rates unchanged at 0.75. And guess who's laughing all the way to the bank, you know? but you were wrong about Aussie CAD being long. It's like I'll be wrong every day of the week if I can cut my losses, keep my losses small, and make sure my winners are twice as big as my losers, okay, or more, okay, and so that takes the pressure off. In fact, if you use a 2-to-1 or 1-to-2, if you're risking $1 to make two, you can be wrong 70 or actually wrong 68% of the time. Now, I want you to write this down. 68% of the time you can be wrong and still break even. Okay, and so all you do is get a couple more trades correct, and now you're making a profit. So it's just how that math actually works out. That you work that math in your favor. And one of my favorite examples is, let's say we had a coin, not a two-headed coin, but a quarter. We play the heads and tails game, and the heads and tails game is if you get heads, then I give you $2, and if it gets tails, then you pay me $1. Okay, so you remember, heads you get 2, tails you lose, you give me $1. Well, in a now you tell me what's the percentage of getting heads on flipping a coin? Who can tell me? In a game of heads and tails, what's the percentage, or what's the odds of getting heads or tails? Info, nice. Yeah, 50 exactly. So if you had a game where you're gonna get $2 for heads and only lose $1 for tails, how many times are you flipping that coin? If you flip that coin 10 times, how much do you make? And then how many times would you flip that coin? It's like I would flip that coin all day long. Because if I flip it 10 times, well, I'm gonna win. I'm gonna win 5 and make $2 in each one. I'm gonna make 10. I'm gonna lose 5 as its tail. So theoretically, I'm gonna make $5 every 10 trades, right? So that's with 50. Being 50% right. Okay. So you would flip that coin and keep flipping that coin. How many times would you flip that coin? You would flip that coin a lot if you had that. This is a positive expectancy, and that's what you're looking for. You're looking for the distance from your entry to, if you're going long, the distance from your entry to the next level of significant support is your stop, and the distance from your entry to the next level of significant resistance should be twice as big as that stop. And when you can identify trades like that, that's a good setup. And you have to be choosy. You have to be choosy. Choosy traders choose, trades with a good risk-reward ratio. You might see, wow, this is bouncing from support. Well, what's the next level of resistance? Well, the resistance is like 5 pips away. Well, that's not a really good. That's not a good trade. So you want to shop around and look for trades that fit your parameters and pass on them. Say, you know what, I don't want to take that one. Yeah, it's bouncing from here and going like that, but it doesn't fit my risk parameters, and so I'm going to bypass, or I'm going to pass on that trade. And I draw a little box. Can we do that here? Oh, I'm clicking with gas here. Let's see. I can do it. Okay. I draw a box like that, and I draw another. Okay. So then in this box, this is my risk, and this is my reward. Can we do it? Yeah. Okay. So the risk, and this is my entry. Okay. I can do something like that, right? Okay. So that's my, and this will be my entry. Oh. So that's my entry. So my entry is here, and then my risk is my, the distance between the level of support, the entry and the level of support is my stop. Okay, so this is my let's do this here. S STOP. Can we do that? Okay, so that's my stop. That's my entry, and my limit is here. Okay, and that space, that's what we're looking for. That space, and so if we have something that's moving, maybe this is your trend, and this is your swing point. Well, this is the distance between your entry and that next level of support is your stop. That's the amount of you have at risk. So entry, there we go. Stop, and you're looking at taking profit. At least 2 times the size of the range. Oh, give me out. Can I get a box? Yeah. Okay. I don't know if I can fill it. Oh, we can really have fun with this. There we go. Um, I guess it won't let me fill. I want to fill it. I want to fill this. Okay. Anyway, well, that would be our limit, and this will be our stop. So we're looking at if this was our trend up, pullback, and then we're looking for, and that's more like a 1-to-1. But we like to see, but the next level of resistance is up here somewhere. That's a good trade. Okay, that's a good trade because all this would be your potential profit target if that's your next level of resistance. The distance from your entry to the next level of resistance is your target. He said, "Well, Greg, I don't see that." Well, then we don't take that. We wouldn't take that trade. Okay, so so looking for being choosy about your trades is an important thing because one of the mistakes that traders make is they take every single trade. I see a trade. They're like that dog in that movie Up. Ball, ball, ball. we say trade, 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 and we're not selective. So being selective about our trades and watching over our emotions, uh, watching our position size, and avoiding over trading. Those are some of the things you actually really want to key on. I know I'd probably give you more. I said, oh, I give you 3. I'm probably give you like 5, and there's a I think the list is bigger than that. But protecting your capital, your monetary capital, your physical capital, your emotional capital, all those are resourcing capital, all ingredients in a successful trade that you need to watch over. So you want to stay tuned for developing a trader's mindset. That's probably what we're going to get more deeper into some of those things I've talked about. And hopefully this was helpful for you. And I look forward to seeing you tomorrow. Remember, we have a great drawing that's coming up, and there's a lot of great information here. So stay tuned. We got probably almost 100 years of trading experience here, and we're happy that you're here. And we look forward to your trading success, and look forward to servicing you in the future. And that's going to be it for me. Well, thank you so much.
Thanks, Greg. This is Tom, Tom Long, and in about 15 minutes we're going to start with our final webinar just this evening. We have 7 scheduled for tomorrow. We're going to be talking about developing a trader's mindset and the psychology of trading. We can't really overstate the importance of these subjects and really try to give you some thoughts here on, more or less mantras on things that we have to focus on. Because stick around in 15 minutes and I'll tell you why. But we're also going to talk about our raffle here at the end of the webinar, so another reason to stick around. Of course, but I know all of you want to stick around to hear me go on and on. But we're going to kick it off here in about 15 minutes, so time to take a little break and be back soon. Thank you.